Hello, everyone, and welcome to Technology Tuesday, hosted by Out of the Box Technology. We're so happy to bring you these free weekly webinars focusing on tips and tricks from in and outside of QuickBooks, hot topics that our industry is encountering, and third parties that we work with and are excited to bring to you. My name is Jennifer, and I will be your moderator today. If you have any questions as we go through the presentation, please feel free to chat those over to me using the question function on your GoToWebinar control panel, and I'll be sure to present those to Mark, our presenter, at the end of the session. Some exciting news that we have going on here at Out of the Box Technology. Last week, we announced that Out of the Box merged with EBS Associates to become one of the largest solution providers for QuickBooks. So it's a very exciting time here at Out of the Box Technology as we bring on more staff and just really expand our services. A little bit about Out of the Box Technology, if you are unfamiliar with who we are and what we do. We're a QuickBooks training, integration, hosting, and support service. We have a whole team of consultants that can help with all of your QuickBooks needs. We also have bookkeeping services. We do website design and custom app development. So a lot going on here at Out of the Box Technology. To learn more, visit our website or shoot me an email. As for today, I am very excited to welcome back Mark Ratcliffe with Avalara, and he's going to talk to us today on how the sales tax landscape has changed over the past year. A lot went on in 2018, and so without further ado, Mark, I will hand things over to you.
Perfect. Thanks, Jennifer. Appreciate the introduction and congratulations on the exciting news with EBS. And we continue to appreciate the partnership that we have with Out of the Box, and certainly I personally appreciate the invitation to be able to speak pretty regularly on these Technology Tuesdays. So let's go ahead and get started. My name is Mark Ratcliffe. I'm one of the national sales managers here at Avalara. To give you a little background on Avalara, we've been around for about 15 years. We're headquartered in Seattle, Washington. I actually work in our Durham, North Carolina offices. We've got about 8 offices worldwide. We handle transactional tax compliance in the US, Canada, and over 100 additional countries. We can do things like VAT compliance in Europe. Obviously, sales and use tax compliance here in the U.S. For Canada, things like HST, GST, PST. But today I'm going to keep the conversation specific to recent changes in the sales tax compliance landscape here in the U.S. that may affect small, medium, and large-size companies. So here's kind of the agenda for today's conversation. We're going to start with talking about sales tax compliance at a very high level. We're going to talk about how companies can determine and how they should be determining their own sales tax profiles. We'll talk about Nexus specifically, and Nexus, to kind of give you a refresher on that, is really an industry term for where companies have an obligation currently to be collecting and filing sales tax. And if we're going to focus today the discussion on the U.S., then we're talking about specific states where they have to be collecting and filing sales tax. Now, there are some traditional rules for establishing Nexus in additional states outside of where you're based, but a lot has changed in the last year, and we'll dive into some of those traditional rules and then what changed last year, mainly due to a Supreme Court ruling, and then how this affects companies moving forward into the future. We'll also talk about how you can actually automate sales tax compliance. That's what we specialize here in Avalara. We've got a software that can help you calculate sales tax in a variety of platforms. We make sure that the tax you're collecting from the customer is accurate, that you're correctly taxing your products, depending on where they're being delivered, or your services if you're a service-based company, or maybe you're a mixture of both. And then we can also help prepare and file sales tax returns in the various states. And then we'll leave some time at the end for some questions and answers. I think I'll probably speak for about 45 minutes, and then we'll open it up to any questions or concerns that you have and make sure that we address those. So this is probably one of my favorite slides in this presentation. And as you can see, this is an iceberg. And when I talk to companies for the first time, or I just talk to general folks just on the street about sales tax, ask them, well, what do you think about? What first comes to your mind if somebody says sales tax or sales tax compliance? And they say, well, hey, it's a rate or it's a percentage. It's something that I pay when I'm buying something online, right? So that's just kind of the tip of the iceberg, if you will. There's a lot more that goes into be compliant with sales tax beyond just understanding what rate needs to be charged on a particular transaction. So we'll widen this out a little bit, and we'll talk about what I mean in a little bit more detail. So number one, if you're a company trying to determine or trying to get compliant with sales tax, make sure you're handling it properly, you need to know where you have nexus. And again, nexus is this industry term for where you're currently obligated, which states you need to be registered in, and you need to be collecting and filing sales tax on transactions into those states. Now, nexus can be created a lot of different ways. There are some traditional rules like having a physical presence in a state, for example, that would give you nexus for sales tax. However, a lot changed last summer with the Supreme Court ruling, and we'll get into that a little bit later, but it relates to economic nexus. The second thing you see there is product taxability, and I would add service taxability to that as well. Now, if you're a company that sells just general tangible property, right? Maybe you sell parts and accessories or something very simple that's a tangible product, you may not have a lot of complexity to the taxability of what you're selling. As long as you're selling it to a company or an end user that is not exempt from sales tax, then what you're selling is probably taxable. However, if you're a company that sells services, for example, or you're a software company, or maybe your company sells medical devices or nutritional supplements, these are all things that are going to have varying taxability from state to state. A lot of companies will sell a mixture of hardware, right? And then they have some services that go along with it. So maybe they go on site to do installations, or maybe they do some consulting or training services affiliated with the product, or maybe they offer a warranty or some type of service or maintenance contract with a product or service. These are all taxed differently from state to state. Jurisdictional assignments, right? So this is where the rates come in. It depends on the state, but right now there are about 13,000 unique sales tax jurisdictions in the U.S. Massachusetts, as an example, is a flat rate state. So there's only ever one sales tax rate that needs to be calculated and collected from a customer for a transaction into Massachusetts. Pretty simple from a rate standpoint. A state like Texas has over 1,600 unique sales tax jurisdictions. There's all kinds of obviously a state rate, but then there's counties that have to be taken into account. There's cities, and then there are local, special, and temporary taxing jurisdictions as well. And these jurisdictions are constantly changing their sales tax rates over time, right? So some of these counties in Texas or cities in Texas, they may bump their sales tax rate up by 0.5% or a full percent next month or 6 months from now. And you've got to be on top of those kinds of changes in order to be fully compliant. Number 4 there is exemption certificates. So if you're a company that sells products to resellers, or maybe you sell to schools, or perhaps you sell to government entities, these are all types of entities that would potentially be exempt from sales tax. And for them to be exempt, in order for you not to charge them sales tax, they typically need to be presenting you with some type of official document proving why they're exempt from sales tax. And this is an exemption certificate. You've got to keep that on file to make sure that if you get audited and they go through some invoices that you send out to customers and they say, well, hey, this is a pretty big transaction. Why didn't you collect sales tax on this? That you can say, well, that was a sale to a reseller, and here's the exemption certificate I have to prove it. Number 5, I won't spend too much time on. This is just the states where you end up being registered, you have to collect and file. Obviously, you've got to prepare returns for those states. Some states might have you file annually. You're not filing very often, but you might have some others that want you to file quarterly, others that want you to file monthly, for example. And number 6, audit readiness. There was a poll, I think last year, done by a pretty well-known research organization here in the U.S., and it related to tax compliance. And I think about 75% of the companies that responded to that poll said that if they were audited for sales tax, they're pretty confident that something would be found out of compliance. So that's another question to ask. If you're going through all this, 1 through 5, based on that, how ready would you be for an audit tomorrow? Do you have all those exemption certificates on file? Are you sure you're charging the right sales tax based on the rates or at the destination address of your products and services? Are you sure you're even registered in the right states, for example? So moving on. Again, this is just sort of a follow-up, a brief synopsis of what we just talked about. Companies, as you're going through and you're determining your own sales tax compliance profile, these are the things that you need to understand. It all starts with Nexus, right? Before you can even think about charging tax or filing a return anywhere or really understanding where you have any obligations for sales tax, you need to know where you have Nexus and where you need to be registered. As I mentioned earlier, it's actually 13,000 plus sales tax jurisdictions in the U.S. And depending on that mixture of states where you're registered, you might deal with a few states that are pretty simple, like Massachusetts with one rate. I think Pennsylvania has 3 rates, for example, but a state like Texas has 1,600. Colorado has over 300. California has over 300. Alabama has over 700, for example. So the list goes on in terms of complexity. Product and service taxability, right? Do you understand how your products or how your services should be taxed, not only in your home state, but in any additional states where you're registered? We talked about exemption certificate management earlier. I won't touch on that any further here, but sales tax returns, again, how many states are you registered in? How many returns are you having to file? Are you sure that process is being done accurately? So let's talk about product and service taxability specifically. These are some rather, I'll say humorous examples of how different states tax different things. But it just goes to kind of show you the level of absurdity that you might see from state to state for a particular product. One of my favorites is if you go into a deli in New York City and you get a bagel, if you get a whole bagel, meaning it's not sliced, it's exempt from sales tax. So you won't be charged any sales tax on that transaction. If you have the folks at the deli slice the bagel for you, you're going to have to pay sales tax on that bagel. And the reason is, or at least New York's stance on this, is because there's a service involved in the transaction now. It's not just a product, if you will. So once the service is involved, all of a sudden that bagel becomes taxable. And as you can see, for takeout in Colorado, this is another rather humorous example. If you're in line at a fast food restaurant and you're getting a combo meal, whatever it is, and you're getting a drink that goes along with that, you'll see that the cup that the drink comes in is actually exempt from sales tax, but the straw and the cup lid is not. Now, why they made that determination, I have no idea. But these two, among the others you see here, among thousands of other rules across the U.S., just shows you an example of, that there's, even though it seems kind of silly in some cases, these are the types of rules, depending on what you sell, that you have to be on top of to make sure you're taxing what you sell appropriately and you're remitting the right amount of sales tax to the states where you're registered. So let's talk about sourcing rules for a moment. This is something I haven't touched on yet. You have to make sure that once you understand where you actually have Nexus and where you're registered, that you're actually collecting sales tax appropriately. There are some states in the U.S. that are origin-based for sales tax. There are others that are mixed sourcing states, meaning in some cases sales tax is derived from the origin address of the product and services, and in some cases the sales tax is derived from the destination address, and then everything else is going to be destination-based. Now that column on the left, the origin-based states for products, what that's referring to is if your company is located in any of those states listed there, it's referring to intrastate sales. So if your company is based in Virginia, for example, and you are shipping a product to another location in Virginia, then the sales tax for a product, right? So let's say that Virginia company is in Richmond, Virginia, and they are shipping a product to Petersburg, Virginia. They're going to charge sales tax based on their origin address for that tangible product, not the destination address of the customer. Right? So if you are based in an origin-based state, or maybe you have another location in an origin-based state, these are things you need to be aware of as well, that oftentimes, depending on the sourcing rule for that particular state, the origin address, not the destination address, may be what you need to look at for a sales tax calculation. Well, let's talk about zip codes for a moment. So I would say probably the number one thing that I hear on calls on a daily basis when I ask folks, well, hey, how are you currently kind of managing all the rates, or how do you know exactly what sales tax to calculate when you're processing a transaction? And a lot of folks will say, hey, I'm using a zip code. I'm good to go. I've got all the zip code rates. I think I'm on top of it. There's no issue there. Well, if you are using zip codes, that is going to be a huge issue from a sales tax compliance standpoint. Zip codes were created to deliver mail. They were not created to kind of manage sales tax jurisdictions. Now, let's use the state of Texas, which I mentioned earlier has roughly 1,600 unique sales tax jurisdictions within its borders. If you're using a zip code to calculate sales tax in the state of Texas, you could potentially have 40 or 50 different sales tax jurisdictions in one zip code. So there's no way that you could, provide a rooftop level accurate sales tax calculation accounting for all of those jurisdictions if you're using a zip code. Now, if you're using a zip code in Massachusetts, you're probably fine because that's a flat rate state. But if anyone on the call currently, if you're thinking, well, hey, this is kind of how we calculate tax across the country, it's probably not as accurate as it needs to be. And I'm going to give you an example of why that is. So what you're looking at here is an overhead view of a specific neighborhood in Commerce City, Colorado. And you'll see that some of these houses are shaded in blue and others are shaded in either green or yellow, depending on how it's coming across on your screen. But if you take a look at the 7450 Layden Street address, you'll see that there is a sales tax rate there of 9.25%. You'll also see the 7495 Locust Street address is 4.75%. Now that's a delta of almost 5% in sales tax rate. And these are houses that are not only in the same neighborhood, but they're really just down the street from each other. So, this is, again, there's definitely some absurdity with certain sales tax rules in the U.S. and the way some of these states like Colorado have laid out their jurisdictions. You've got to be using a rooftop level accurate solution to calculate tax if you're going to know that one house across the street from the other, there's a delta there of 5% in the sales tax calculation. You can even see some of the houses that are isolated completely by themselves in green or yellow in that sea of blue, for example. And this is only one neighborhood in Commerce City. If you're looking at the whole state of Colorado or the state of Alabama, for example, these are two states that are notorious for having sales tax jurisdictions laid out very similar to this. Let's talk about Nexus for a few minutes. Now, I mentioned earlier that there are some traditional ways that Nexus has been created in decades past. I believe since the early 1990s, the most common way that a company would trigger Nexus in another state would be through a physical presence. So if your company is based in a particular state, but you have remote employees that live and work in other states, or perhaps you have a traveling sales force that goes into other states and they go to trade shows and they go to events and maybe they go on site to visit clients and kind of pitch product and services. If you have products that are stored in a third-party warehouse or even your warehouse in another state, these are all things that can trigger sales tax Nexus historically. Anything that you can think of that would be a significant physical extension of the company would typically do that. Now, there are some other unique ways to trigger Nexus that have been around for a while as well. For example, you'll see up there working with affiliates. Affiliate Nexus is interesting. There's a particular type of affiliate Nexus called click-through Nexus, which essentially means that if you put a link to your website on another company's site to try to drive traffic to your website from their website, you create this affiliate relationship that a lot of states will say triggers Nexus in the company where that affiliate or kind of your partner, if you will, is located. Now that's a very interesting type of affiliate Nexus that not a lot of companies are aware of. But a lot of times these activities that are web-based that drive traffic to your website could be creating Nexus for you in quite a few additional states, depending on where these other companies are located. If you use drop shippers or vendors, for example, that can potentially trigger Nexus in other states as well. And if you're a technology company, even if the only thing you have in another state is say a server bank, very often that can give you Nexus as well. So what we're talking about now is kind of these traditional rules for creating Nexus that have been around for several decades. Now, let's talk about kind of what changed last year. And I'm going to get into the specific Supreme Court ruling in just a moment, but let's look at 2018 by the numbers. 30 states to this point, it's even higher than that actually. This slide's a little bit outdated. Well, obviously, and we're also talking about 2019 as well, but have adopted economic nexus laws. I'm going to get into what economic nexus is as well, but it is a rather new version of kind of a nexus trigger that your company can potentially do depending on your economic activity in a state, not necessarily if you have a physical presence there. You'll see 8 states have also become marketplace facilitator states. Now, what that means is, and I'll use Amazon as an example because that's a marketplace that I'm sure everyone's pretty familiar with. Amazon and some of these other marketplaces went to specific states. I'm sorry, reverse that. A state like Washington or Pennsylvania actually went to the marketplaces specifically and said, hey, we don't want to have a relationship with all of the individual sellers that have product in this state or have nexus in this state. We just want you, Amazon or eBay, or insert your favorite marketplace here. We want you to collect all the tax. We want you to remit it in bulk for all these sellers. So that's going on currently in 8 states for specific marketplaces. You'll see that there's some additional states established use tax reporting requirements. Again, I talked about click-through nexus. There's actually 2 additional states that added click-through nexus. And then there were 8 states that did offer some type of amnesty program for companies that had been out of compliance for a few years and kind of wanted to get registered and move forward, but there might have been a little bit of past exposure to clean up before that happened. So let's talk about the Supreme Court ruling last summer specifically. Now, many of you may have heard of this. South Dakota versus Wayfair was a decision that came down in late June of last year. And the physical presence rule that was overturned was a decision from back in the early 90s, Quill Court versus North Dakota. And that decision essentially said that really the only trigger for nexus, or one of the only triggers for nexus, the main trigger would be physical presence, right? And that was in play for several decades. But what South Dakota versus Wayfair did is it introduced this concept of economic nexus. But let me give you a little bit of background on kind of what happened that led up to this court ruling. South Dakota at one point went to the company Wayfair, and I think this was a couple years ago, and essentially said, hey, you're shipping so much product into our state that we feel like we have a right to some sales tax on these transactions. And Wayfair was like, no, I don't think so. We don't want to comply with that. Anyways, it made its way up through the court system and it eventually ended up in front of the Supreme Court. And last summer, the Supreme Court ruled in favor of South Dakota. And what that means for companies moving forward is, even if you don't have a physical presence in any of these states that have economic nexus laws, if you sell a certain dollar amount of your product into the state or your service into the state, or you have a certain number of unique transactions, right? So just think of this as economic volume or sales volume into a state, that can now trigger sales tax nexus, right? So physical presence is still very much in play. It didn't go anywhere, but it is now not the only kind of main trigger for nexus moving forward. And I've got some additional slides with some additional information. The companies that are affected are remote sellers into states. And if they don't have a physical presence, then they have to know if they're doing $100,000 in total sales or 200 or more transactions into a particular state. Now, the ruling obviously applies to South Dakota, but since the ruling, about 30 additional states have hopped on board with economic nexus, and they now have announced thresholds. California, for example, just enacted their law on the 1st of this month, so about 22 days ago. And they have similar thresholds to what you see here on the screen. Now, there are a few outliers. I think the state of Texas right now has, I want to say it's $500,000 as a total sales threshold. Don't quote me on that, but I think that's correct. And there are a couple other states that have $250,000. But the vast majority of the states have adopted what you see here, $100,000 or 200 annual transactions. And the effective date for South Dakota was November 1st of last year. The other states that jumped on board, their effective dates have varied. So there are some that were on board immediately when the ruling came down last summer. Some waited until the end of the year. Some waited until January of this year, and some have gone on board more recently, such as California. Some frequently asked questions about this ruling. You know, if you're already registered in South Dakota, does it apply to you? No, it doesn't, because you already have nexus in South Dakota. So you are already collecting tax and remitting tax to that state, assuming that your product is subject to tax in that state or your service is subject to tax. Now, the second one you see there is very important because this comes up on a lot of my calls. There are a lot of people out there that think that the South Dakota versus Wayfair ruling and economic nexus only applies to online sales or online transactions, and that is simply not the case. It applies to every transaction that you have into other states where you're a remote seller. Keep in mind that if you're taking a look at these thresholds and you're trying to understand, well, hey, have I gone over the $100,000 in total sales or the 200 unique transactions? Be very careful when you're analyzing the state's threshold so that you understand if that particular state is only looking at taxable sales or retail sales, or if they're looking at all transactions, all sales, meaning including your wholesale transactions for those sales you have that are exempt from sales tax. I can tell you that California, for example, is only looking at taxable transactions. However, the vast majority of the states, including a state like South Carolina, is looking at both taxable and non-taxable sales. So the last thing you see on the slide there is a little bit poorly worded, but does economic nexus apply to non-taxable transactions? Well, the second piece there, the ruling does not change what is or isn't taxable. That is true. The Supreme Court ruling didn't change whether or not your particular product or service is taxable in a certain state or not. It's subject to tax. However, those thresholds, right? Again, that you're looking at, have I crossed 100K in total sales? Some states are only going to look at your taxable sales, accounting towards that. Some states are going to look at taxable and non-taxable. So again, this is kind of reiterating what we've already talked about. But the thing to keep in mind is it's not just physical presence anymore that gives you nexus in a state. And probably the best way that I've heard, and this is a state official said this on a call with me, or on a call that I was part of a couple of weeks ago, and they said, what's interesting about this decision is now companies cannot control where they have to collect and file sales tax. And if you think about that for a moment, that's very true and it's very impactful. In the past, if really the only way you created nexus was through a physical presence, well, you could control where you hire employees. Right? You can control where you send a sales force. You can control where you store products. You can control where you put your servers. All these things would have been under your control. However, now that economic nexus is in play, your customers are potentially going to control where you have to collect and file sales tax because it's all dependent on your economic activity into those states. So again, economic nexus, very general, high level. What is it? Right, it's a collection obligation imposed on sellers based on economic activity, not a physical presence. Right? What are your total sales into a state? What are your number of transactions? That's what's triggering economic nexus. Now, if you have physical presence nexus already, right, whether you're already registered there or maybe you had physical presence there a couple of years ago and you didn't get registered and you haven't gotten registered at this point, economic nexus is really irrelevant. Right, and that's coming up on a lot of my calls recently as well. Is there are a lot of companies that see the Supreme Court ruling last summer and their reaction to it is, oh, well, we better go get registered now because it looks like we have nexus. But they may not be taking into consideration that they've had a remote employee in a bunch of these states for 4 or 5 years. Or maybe they've been participating in Amazon FBA for 4 or 5 years and they've had products stored in a warehouse in those states. Or maybe they went to a bunch of trade shows in those states. So they could have triggered nexus in the past through a physical activity, which essentially makes economic nexus irrelevant. They already have nexus. Now, if there's concern about exposure that needs to be cleaned up, certainly that's something that you want to look at prior to getting registered. Did you have nexus at any point in the past, and should you have been collecting tax over that time? That's something to consider before you go get registered, because when you register, some of the first few questions that a state will ask are things like, well, are you a marketplace seller? How long have you been in business? Is this, when to the best of your knowledge did you establish nexus in our state? Do you store product in our state? All these different kinds of questions that will usually give them enough information to know if they should, start poking around and kind of asking about the past potentially. So states in action post ruling. What you see here, this chart is accurate as of about, I want to say about 15 days ago. You'll see California is added, but these states that you see highlighted in blue are the states, including South Dakota, that have jumped on board with economic nexus since last summer. So you can see there that it is the vast majority of the states, and 5 of those states you still see in gray. The reason they haven't jumped on board is because they don't have a sales tax. So Oregon, for example, Montana, New Hampshire, Alaska, Delaware, these, we call them nomad states. It's 5 states that don't actually have a state sales tax. So you can see outside of those states with no sales tax, there are very few states kind of left standing that have not jumped on board with some type of economic nexus threshold. What does this mean for an Amazon FBA seller? A lot of my calls on a weekly basis are with marketplace sellers. And Amazon's model is very unique because if you sell through the Amazon space, you have a couple options for fulfilling orders. You can have Amazon sort of facilitate the transaction for you, and then you can choose to facilitate it. So you have control over where your product is, when the transaction is finalized, and you can ship the product out to the customer. If you participate in FBA, which means fulfillment by Amazon, what that means is that you're sending your products to Amazon. Now, you may only send the products to a couple locations, maybe a couple warehouses in a few different states, but Amazon has fulfillment centers in roughly 30 states currently. And once they have the product, based on how it's selling and where it's shipping throughout the country, they can move that product throughout that network of warehouses in order to fulfill those orders more efficiently. And once your product is moved around to these various warehouses, technically that's a product that you own that's being stored in a third-party warehouse. That gives you physical presence nexus, right? Which is it's a historical way that you can trigger nexus, but it's still very much in play. So the reason that Amazon FBA sellers are even more so affected by this economic nexus ruling is they very likely already had sales tax nexus in somewhere in the range of 20, 25, 30 states because their product had been stored in warehouses for the past several years, depending on how long they've been selling through Amazon. But now, even in states where they're not physically located or they don't have a product that's being stored, if they're crossing economic nexus thresholds, then that's a whole additional range of states where they may have to go register, collect and file sales tax. So the next logical question is, and this is kind of where we come in, is can all of this be automated? And the answer is yes. So we can help. And this is sort of what we specialize in here at Avalara. Number one is nexus determination. So we have a team of sales tax experts in-house. We call them our tax advisory team. They're made up of some fantastic individuals that are CPAs, tax attorneys, former state auditors, and some of the services that they provide are around nexus determination. So we can do a professional nexus study that will look at things like where your company has a physical presence and if any kind of physical activity you've done has crossed a nexus threshold. Now, if you've got a brick and mortar location in another state and you're not registered there, you wouldn't have to pay for a nexus study to know if you have nexus there. That's pretty cut and dry. However, if you have a traveling sales force, for example, or you have representatives that will go to trade shows periodically, it depends on the state what their rule is for having boots on the ground in the state. So in one state like Texas is pretty rigid. If you go to one trade show one day, you really don't have to be there very long. That's going to trigger sales tax nexus. However, other states may have some longer periods that you have to be there. You may have to be doing a specific type of activity. It may have to be a certain number of people. There's all sorts of rules, right, that can come into play from state to state. That's where a nexus study is beneficial because we'll find out what those activities are from you, and then we'll go do the research with the specific states and say, yes, based on your activities, we think you have nexus in this state, for example. And we also now factor in economic nexus. So as long as that you can provide us some historical sales data for your company, either in 2019 or 2018, we can go back and look at these economic thresholds that have come from the ruling last summer and determine if you've crossed any of those thresholds as well. And I have one other comment to make about these economic nexus thresholds, even though it's not necessarily related to this slide. As you're going back through these thresholds and saying, hey, well, if I crossed 100K in this state, if I've done 200 transactions in this state, for example, keep in mind that these states are looking at calendar years. So the state of California's law went into effect April 1st of this year, about 22 days ago. And their stance is, if to that point, meaning April 1st, if to that point in 2019 you had crossed either one of those thresholds, they want you to get registered. However, California is also looking at the preceding calendar year, as are most of the other states. So if you haven't crossed economic nexus in 2019, they're also asking you to go back into 2018 and see if you crossed any of those thresholds in 2018. If the answer is yes, they want you to get registered, right? If the answer to those is no, meaning you haven't done it in 2019, you haven't done it in 2018, then you just have to keep an eye on the threshold and keep an eye on your sales for the remainder of this year, and then make sure to get registered as you either approach or surpass the threshold. So back to how we can help, we can do a professional nexus study if your company has particular questions about where you may have created the obligation to be registered, collecting, and filing sales tax. Registrations and licensing. So the next step in that process, once you understand where you need to be registered, is you can either register yourself or you can outsource that project to us. We have a service that will get you registered for sales tax in every state. Usually takes a couple weeks to complete, but the end result is the state will give you a sales tax ID number. That means you're officially able to collect and file sales tax in that state. And they're also going to give you a filing schedule. So if you were to go register in 10 states tomorrow, you might see some of them want you to register, some will want you to file annually, some might want you to file quarterly, some might want you to file monthly. And the next piece is our software. Our core product is called AvaTax. It's a cloud-based tax engine that will integrate with about 750 proprietary platforms currently. We do have integrations with QuickBooks Desktop, with QuickBooks Online, many other ERPs, invoicing systems, e-commerce, shopping carts for folks that are selling online. And the software is able to calculate tax live as transactions are being processed. It's also able to determine the taxability of the products and services that you're selling into a particular state. And then we can auto file for you. So if you end up having to go register in a bunch of different states because now you have economic nexus there, and you get the registrations done, and then you say, well, now I got to file like 150 or 200 sales tax returns that I didn't have to do before. What do I do? You can outsource that to us. So we can calculate all the sales tax that you have, and then we can prepare the returns. We can file those on time with the various states automatically, and then remit the tax that you've collected. So if you think about what companies like ADP and Paychex do for payroll, this is a very similar automated solution for sales tax. AvaTax is, again, it's a tax engine in the cloud, right? So what you see here is a little bit of an outdated view of an invoice in QuickBooks Desktop, I believe. But essentially how it works for QuickBooks specifically is your process, once our plugin is integrated with QuickBooks, your process to create an invoice is not going to change. You're going to select your customer like you normally would. You're going to add the items that they're purchasing, the addresses will populate, and you'll save the invoice. What's different is when you save the invoice, there's a split-second call from that invoice to our tax engine in the cloud, and 0.2 of a second later, we're going to return a sales tax dollar amount that accounts for all the jurisdictions in play at that address. You'll see, hopefully it's coming across on your screen, but you'll see that the destination address here is Half Moon Bay, California. I happen to know that at that address, there's, I believe, 6 different sales tax jurisdictions: state rate, county rate, city rate, and there are 3 either special or local or temporary taxing jurisdictions in play as well. So we're not only accounting for the jurisdictions at that particular date and time at that address, we're going to look at the different items that are being sold and determine their taxability at that address. So let's say that you're a company that is selling software as a service, and you also sell maybe some implementation support or some like a maintenance contract with the software, and you're selling that into California. Well, California doesn't tax software as a service, so our software will know that. However, if you sell a maintenance contract related to that software, it is subject to tax being taxed at 50%. So it's partially taxable in California. So, you know, that's just one example, but our software is able to do this in real time. What are the rates in play, specific date and time, and then what's the taxability of what's being sold. This also works for shipping fees. So our software will know if, for example, one state doesn't tax shipping, but a neighboring state does tax shipping. This is something that affects a lot of online sellers. As I mentioned before, we've got, it's actually over 700 now pre-built integrations into a wide range of CRM platforms, e-commerce shopping carts, point of sale systems, enterprise level ERPs. I mentioned QuickBooks Desktop, QuickBooks Online, inventory management systems like Fishbowl as well. And just a few more. But this is what really sets us apart from other, shall we say, competitors in the space, is the scalability that we offer. We can start with your company when you're using, QuickBooks and a shopping cart now, and if we fast forward 10 years from now, and you're on an enterprise level ERP, and you're using all kinds of different shopping carts, and you're selling through marketplaces, and just a wide range of platforms, there's a good chance that we're going to have integrations into the vast majority, if not all of those. So we can scale with you as you grow to calculate the tax appropriately, and as I mentioned, prepare the returns and then file those on time with the states. So to summarize, here are the things that your company will want to be doing to reduce your risk in the sales tax compliance landscape currently. Number one, evaluate where you have a collection responsibility. And this goes back to where you have nexus, right? Right now, are you confident that you're registered in all those states where you've got a substantial physical presence, meaning remote employees, traveling sales folks, going to trade shows, storing product, having a server bank, delivering product with your own trucks, for example, which is something I haven't mentioned previously. If you use a common carrier like FedEx or UPS, that typically doesn't trigger Nexus. But if you deliver products into other states outside of where you're based and you use your own trucks, that is typically very much a Nexus trigger. So keep that in mind as well. Ensure that your platforms, your systems are properly tax sensitized, right? So making sure that, hopefully you're using a solution that will calculate tax. So something like AvaTax, for example, to calculate the tax properly and accurately on every transaction based on the rates and rules and boundaries at that particular time and date. But number three, evaluate the kind of risks of what you're doing, right? You want to make sure that you're registered in all the states where you have these requirements, because you don't want to not be registered even though you have this obligation, and then a state knock on your door 5 years from now and they do a little digging and find out, well, yeah, you actually had a remote employee in our state for the past 7 years. Now we want all the back tax on all the sales you've had into our state, and this is not tax you would have collected from your customers, right? So that can be difficult to manage in the event that happens. And evaluate technology solutions, right? There are other companies out there that offer a similar product, but what I would say separates us from them is, number one, the scalability, but number two, the accuracy of the content behind what we're doing. When we calculate sales tax on a QuickBooks invoice, for example, and there's a quick call to our tax engine when you save that invoice, we're using geolocation to calculate the sales tax, meaning we're taking that address, we're converting it to lat long, we're drilling down to the rooftop, and we're accurately grabbing every single sales tax jurisdiction that's in play for that particular date and time. We've also got the content to manage the taxability of over 3,000 different products and services across the country. And to give you some background on us, we've got over 100 folks here internally that work on our content team. And their job is to keep their fingers on the pulse of changing rates, rules, and boundaries across the country at all times. So that's how we know if a random county in Texas bumps their sales tax rate up by 0.5% next month. Or that's how we know that California doesn't tax software as a service now, but let's say maybe 2 years from now they pass a law where they say, hey, we didn't tax it before, but now we're going to tax it at 50%. If you're using an AvaTax, or if you're using AvaTax, you're not ever going to have to manage any of those rates, rules, boundaries, legislative changes manually moving forward. And another exciting addition that we now do is we track economic nexus. So if you were to plug our software into QuickBooks and you were to say, hey, I want you to calculate tax in these 5 or 6 states because this is where I'm currently registered, this is where I have nexus. That's what we'll do. However, we will track the number of transactions that you have in every state, and we'll also track the total sales that you have in every state. And that way, our software can alert you when you're approaching these economic nexus thresholds in additional states. So if you feel like, hey, these thresholds, this is really difficult to have to maintain or track on an ongoing basis, our software can also help with that. So again, I want to appreciate everyone for attending today. Jennifer, everyone at Out of the Box, appreciate the invite to speak. I'm more than happy to answer any additional questions or concerns if you want to chat those over.
Great, thank you so much, Mark. This was an awesome presentation. Every time you guys, talk about this, I learned something new, and I'm just really in awe of how detailed and complex the process is, and what a great solution that Avalara offers. So thank you so much for coming to us today.
Of course, thank you.
I don't have any questions that came in during the presentation, so you were very thorough. But if anyone listening on the line does have anything to ask, go ahead and chat that over right now. But yeah, we do appreciate you guys coming on with us. I know that we work closely together with Avalara and Out of the Box Technology, so appreciate your time. And this session is being recorded. So if anyone wants to go back and watch anything back or just revisit any of the areas, you can go ahead and do that. I do have a question that just came in, and it is, does this integrate with QuickBooks POS?
I don't believe so. I'll double check on that. I think currently our integrations are only for desktop platforms and QuickBooks Online, but I will double check that today. And then my contact information is now on the screen as well. So if you have any kind of one-off questions like that, and they maybe don't come to you right now, and you think, an hour from now, oh, I really wish I'd asked this, feel free to shoot me an email. Feel free to give me a call. Happy to answer any additional questions. But I believe currently our integrations are only for desktop and online platforms.
Okay, great. Thank you so much for answering that. Yeah, and I was just going to say, if you wanted to share your information, if people did want to reach out, either for more information or to get started and start working with you guys there at Avalara, please do. That's really the reason that we bring these webinars each week, is to make these connections and help our audience find the solution that they need. So thank you so much for that. All right, so yeah, I'm not seeing any other questions come through. So with that, I do thank you so much, Mark, for joining us today. It's been a pleasure, as always, to have you present to our audience. I know you've done one for us internally as well, and so we do really, really appreciate your time so much.
Absolutely. We appreciate you all as well, and thanks for the invitation, and we look forward to future conversations.
Of course. Thank you. So at this time, I'm going to switch gears just a little bit and go ahead and share my screen again, just to invite everyone to future webinars that we have. In 2 weeks, we will be delivering our Recur 360 quarterly updates. And we're also going to just kind of do a high-level look at Recur 360 as well. So if you are new to these and you're not sure what Recur 360 is, it's an app that out-of-the-box technology developers actually created as a solution for recurring and automated invoices, payments, and collections. So we will touch on, again, high-level what Recur 360 is, and then some updates that we've made since February. A really great thing about the fact that Recur 360 is our product is, as our users are in it and they say, oh, I wish it did that, or how about if we can do this, our developers are right there and can make those changes. So we'll go over some updates. And then on May 14th, we'll have our bookkeeping manager, Sharon Horger, is going to join us and talk about the bookkeeping services that we offer here at Out of the Box Technology, and then on throughout the spring. So please feel free to sign up for any or all of these that might interest you. They're all completely free, and you can sign up on your blog, or on our blog, excuse me. And in just a short while this afternoon, I will send an email to all of you who are here live with a link to this recording, as well as a link to sign up for our future sessions. So again, thank you all so much for joining us today. If you're watching on demand, we thank you for listening as well. If you need any more information, you can contact Mark. As he said, you can also reach out to me directly or visit our website or give me a call. Also, if you had some topics that you hoped that Out of the Box Technology would do a presentation on, please go ahead and send that to me as well, and we will find the best suited expert to bring that information and get it on the schedule. So thank you all so much. I hope you have a great rest of your week.